Britam Asset Managers was set up in 2004 really to provide asset management and investment support to Britam Insurance Company. And in fact, the insurance company was the first client of Britam Asset Managers. But 1 or 2 years later, the business then acquired what I would call a third-party mentality and really set up to try and then manage third-party funds. So we started managing unit trust funds in 2006. This is inviting members of the public to invest money with us. And from zero, we have since grown to about 126 billion shillings in assets under management as at November 2017. And we're very proud to say that of that 126 billion shillings, only about 15% is from the mother insurance company. So really, we are a third-party asset manager. We manage money for non-related, what I'd call non-Britam insurance-related parties, which means that we're a standalone asset manager. We need to have proper processes, good investment expertise, a good team, and good capability to be able to then attract sort of investments and investors from outside the Britam group. If I look at the business the way it was 3 years ago, the business was going through a lot of turmoil at the time. I think it's well known that Britam Asset Managers had some turmoil with the exit of some key staff. And by the time I came on board into the business, maybe 2.5 years ago, the business was suffering from the point of view of investment returns, capability, staff complement, structure, and so on and so forth. But within that time, we have managed to get the business on the right foot. I now say that assets under management in that period are up close to 50 or 60%, and profitability has since doubled since that stage. We are very proud because now we occupy, in my view, a top 3 or top 4 position in terms of assets under management, in terms of market share, and we are now number 1 by quite a mile in as far as revenue share and profit share is concerned in this market. I'll give it down to the nature of our portfolio mix. About a quarter of our assets are retail assets, and retail assets give us 10 times the fees of the institutional space. And I think secondly, the superior distribution that we've been able to have over time in collaboration with the insurance company and the insurance group has really meant that in terms of diversity, in terms of product mix, and certainly in terms of the spread of profile of investor, that has proved to be very beneficial to the business. I would say the uptake in the retail market is not as strong as it should be. If you do look at what's happening at things like equities and bonds, it's a very disintermediated market. That means that people prefer to invest directly and not go through intermediaries. So we still have a lot of retail investors who want to invest directly into the stock market. We have a lot of individuals who want to buy T-bills and treasury bonds directly, as opposed to going through a fund which is more diversified, is managed by professionals, and so on and so forth. So I think that certainly has been a challenge. And I think distribution as well has been a huge challenge for what I would call the general asset management industry in East Africa. Just reaching the common man on the ground and just spreading that awareness about asset management and investments, and just having enough boots on the ground to rotate through not just the city but several counties in the country has proven to be a challenge. And I think for us, the reason that we've done fairly well, and we're now managing about 30 billion shillings in retail assets under management, has been our distribution, because we have partnered up with the insurance company. The insurance company has more than 3,000 financial advisors across the country, and they actively sell asset management. So there are a lot of people who are now familiar with what it is that we're doing, but my sense is that we've just touched the tip of the iceberg. We can certainly do more to spread global awareness around investments and what needs to happen to make sure that people's savings and retirement, at least at minimum, keep pace with inflation or outpace inflation. My sense is that demand exceeds supply of investment opportunities. As an example, the pension fund industry has tripled in size over the last 6 to 7 years. We've gone from 200-300 billion shillings at the start of maybe 2010, that kind of thing, to 990 billion shillings as at the end of this year. In fact, in another maybe year and a half, we'll be at 1 trillion shillings. Now, the capital markets have not kept pace with this. As an example, we still have the same 50 or 55 odd listed companies on the Nairobi Securities Exchange. That number has remained the same for the last 10 or 15 years. In fact, we have more instances of companies delisting rather than listing. If you look at the government bond market, we have 1 or 2 bonds issued every year. A lot of appetite in the primary market, but not sufficient liquidity in the secondary market. And there are some initiatives to address this, but they are yet to come to fruition. If you look at the corporate bond market, we have 1 or 2 corporate bonds a year that are coming through.
Actually, it's really slowed down.
It has really slowed down. So those generally are issues. So for a growing fund, which has growing contributions, what do you then do with the money? It then means that you need to deploy money into the stock market. Remember, the whole market is looking at these same 50 stocks. To be honest, of the 50, it's probably about 20 that are actually investment grade or investment ready in terms of liquidity and so on and so forth. So what simply happens is that you end up just chasing prices because you really want to just capture the asset. So we have been forced to also innovate as asset managers because you now need to be able to innovate and come up with investment opportunities to deploy this money effectively. Hence the rise of alternative investments. So, so corporate debt, private equity, property investments, energy investments. We've now begun to see more allocation come through in this space, not just to diversify risk and to find a home for the investments, but also to ensure that the return proposition is then balanced out. And if you look at Kenya, we have a tremendous burden on our shoulders that has been placed on us by the rest of the continent, because a lot of foreign investors are looking at Kenya to carry the burden of the Africa Rising narrative. South Africa is not doing very well. In fact, by some accounts, it's in a recession. Nigeria is currently going through a crisis in terms of political economy and macroeconomic activity. Egypt is currently going through the tail end of a macroeconomic crisis and political crisis as well. So for a lot of investors, East Africa then is the only place that looks viable and stable enough to be able to generate some promise of investment return. And when many investors look at look at East Africa, Kenya occupies an outsized role in their investment thinking. So we have to get it right, and because we have lots of money flowing into the country. But it cannot all best be chasing bonds and equities. So there's a lot of focus as well on alternative investments coming through from these people. And I think with the kind of focus that we have seen from the government, from the point of view of infrastructure spend, I'd love to see them capture some of these flows to fund their massive appetite for infrastructure, as opposed to borrowing domestically. And if you do look at other countries around the world, it is pension funds that fund the construction of infrastructure. So roads, bridges, hospitals, trains, airports, these things tend to be owned by pension funds, purely on account of the size of the investment and the kind of time that is required to recoup the investment. So we are there. There's 1 trillion shillings waiting. But it simply needs to be organized, and organized through a vehicle that can then be able to access the investment. And as pension fund managers, we sit on the buy side. We're not here to structure investments. We want to receive term sheets from what I call the sell side. Transaction advisors, investment banks. Let them go and design transactions that we can then look at and deploy funds into. But when the asset manager is responsible for managing funds and also creating the investment, you have a challenge. That's why we have a disconnect. That kind of thinking needs to be addressed, in my view, immediately, because 1 trillion shillings sitting there needs to be deployed into those things that I've just described. My sense is that I usually ask them to look at the story of Britam. Britam is 50 years old, and we intend to be here for another 50. So regardless of the environment, people still need to be able to proceed. What then changes is the investment strategy and the investment approach to suit the environment. But that doesn't mean you then, as a result of going on in the political economy, then take your money and stick it under a mattress. My sense is that the goings on on the political scene will sort themselves out. They have to. It's not something that can endure for another 1, 2, or 3 years. And what will then happen is that when you then look with the benefit of hindsight, 3, 4, 5, or 6 years from now, it will be the decisions that are made now that will then impact what your investment portfolio and returns and structure then looks like at that point. So in my view, one has to look at this thing from an overall strategy perspective. Regardless of the political economy, one has to have their own investment objectives and investment strategy. Are you more risk averse or not? What is your time horizon for investment? What kind of investment returns are you targeting? Once you have a general understanding of that, you then need a tactical approach to suit the environment because things keep on changing. But one must not lose sight of the investment goals because those goals are not going to change regardless of the political economy. So if you're saving for your son's university education, as an example, regardless of what goes on in the political economy, your son still needs to go to university. Your capital still has to grow at a rate over and above inflation so you can be able to meet those school fees. That doesn't change. If you're saving for a wedding or saving for a car or saving for whatever it is, that is not going to change. You are still going to need a home and save towards a home regardless of the outcome of the political economy. So you better have your investment objectives well set up front and then come up with a tactical way to then mitigate the current environment. But that doesn't mean your objectives change. And I think that is the approach and the philosophy that we have used with many of our investors. And in my view, that is why the business is increasing and not stagnating. I think the value proposition for us is the brand equity. The brand equity is then underpins the very strong investment promise that we deliver to our customers. I think the second issue is certainly product diversity. We think we have something for almost everybody, whether you're institutional or retail, Kenya shilling or US dollar, traditional investor or alternative asset investor. You certainly want to invest with us because of the personalized service. We have a very strong team that gives very strong customer service, so each and every one of our customers seems valued. And I think just if you look at the historical track record from the way we've done things, that has been able to convince a lot of people that we know what we are talking about and their funds are certainly safe with us. So I think that is a message out there to the investing public. Certainly my message to you as a Cheng as well and to your team. We want to do business and we're open for business from the point of view of asset management.